Hi, good morning. I am so excited for my last video for the quarter. So this is my fifth video for the Saving Your Future book, and welcome again, my Saving Your Future book clubbers. I hope you're getting a lot of information from our discussion from the book, and I hope this is gonna be adding more knowledge to yourself. Okay, therefore affecting your financial decisions every day. Okay, and I hope it's gonna give you a better option of deciding on things that you have to do in your financial future. Okay, so for our last segment for this quarter, I will be continuing to talk about the taxes. Okay, how it affects our decisions and how it affects our the way we look at how to save money. Okay, so let me share my screen with you. So we stopped, I believe we stopped on page, page 16 of the Saving Your Future book, okay? Access that one. All right, so let's continue, okay? So let's talk about taxing issue. So taxing issue taxes take a big chunk of your money, okay? Everybody knows that. Any saving and investment strategy must consider the tax impact on it. What is your current tax rate? Okay, make sure you know that. What will the tax rate be in the future? Will it go up or will it fall? Okay, so let's look at the challenges ahead. The shrinking tax base. As mentioned, since 1945, when Social Security began, workers per retiree shrank from over 40 to about 3 today. This was in 2015. Who knows? In 2020, what is the ratio of people paying taxes versus people who are taking out Social Security? I think it's already like 1-to-1. Okay, and the number of continues to decline due to the aging demographics of the U.S. and Canada. So governments will have a hard time sustaining the existing systems of Social Security, the Canadian pension plan, and the general benefits that seniors receive today. Okay. So mounting debt. As of January 2015, the U.S. debt stands at $18 trillion, a burden of $56,500 per citizen. It was just $13 trillion 4 years ago, okay? Canada's debt is 692.4 billion, okay, Canadian dollars. An average burden of 19,590 Canadian dollars per citizen. Imagine that, okay? So guess who is going to pay for this debt? Our future generations. The government borrows most of it through public debt, which it owes to individuals, businesses, and foreign governments who bought treasury bills, notes, and bonds. So foreign investors hold the largest share of the U.S. national debt. China and Japan top the list, holding more than $1 trillion each in IOUs. Okay? As the tax base for workers per retiree is shrinking, the cost to provide retirement benefits, Medicare, defense, and infrastructure continue to rise. The government will have to choose between cutting down the budget or raising taxes. Many people believe taxes may have to go up in the future. So what do you think? If you want more information on the live debt of the United States, go here. Go to usdebtclock.org. Okay, very interesting when you look at that. So let's talk about capital gains tax, okay, on page 17. Almost everything you own and use for personal or investment purposes is a capital asset like your home, stocks, and bonds. So when you sell capital assets, the difference between the amount you sold it for and your basis, which is usually what you paid for it, is a capital gain or capital loss. So capital gains or assets held for less than 1 year is a short-term gain and usually taxed at ordinary income tax rates. Okay, so now what do we do? Okay, so do you know about tax now, tax later, tax advantage? So where does your money go? Let's take a look of the following tax treatment and different types of investment accounts in the US. Okay, so where do you put your money? Okay, if you're putting your money in checking, savings, CDs, stocks, and mutual funds, you're being taxed now. Okay, that means you're paying tax already. Okay, now if you're putting your money in 401k, 403b, IRA, SEP IRA, annuity, and pensions, that means you're getting taxed later. You're not paying tax now, but in the future, when it's time for you to get your money, you're going to have to pay taxes, okay, based on your tax rate, okay? What is tax advantage, okay? So if you put your money on these different engines, that means you're not getting taxed, okay? Like Roth IRA, 529 college savings, municipal bond, health savings accounts, life insurance, and long-term care benefit. These engines have tax advantage. That means you don't have to pay for taxes, okay? So make sure you know where you're putting your money. Okay, in Canada, okay, if you put your money in checking, savings, GIC, stock, mutual fund, bond, interest income, non-registered investments, that means you're paying tax already. Okay, tax later, RRSP, that this is one of the retirement plans for Canada, RRIF, LIRA, LIF, RESP, annuity, pension, CPP, OAS, RDSP, these are tax later. Okay. Tax advantage, okay, make sure you're looking at these engines here because these are the ones that you want to put your money in to save taxes. TFSA, okay, life insurance benefit, individual critical illness, disability, insurance, health insurance, primary residence, okay? So take a screenshot of this one so you know where to put your money, all right? Okay, what does it mean? Let's talk about it in detail. Tax now means that any earnings from these accounts must pay tax for that year. For example, you must report and pay tax on earnings from savings accounts, certificates of deposits, dividends from stocks, mutual funds, and money market funds. In Canada, guaranteed investment certificates or GICs, term deposits, and any investment or savings generally held in a non-registered plan would fall into this category. What is tax later? Tax later means the money you put in is pre-tax. Pre-tax money deposited in an account is money that you have not paid income tax on, but you'll definitely be paying tax later when you withdraw it. These accounts are also called tax deferred. In the US, tax deferred accounts commonly take the form of IRAs, 401ks, and 403bs. In Canada, registered retirement savings plans, registered educational savings plans, and registered disability savings plans are popular tax deferred vehicles. In the US, when you begin to take money out after 59 and a half, you'll be taxed at ordinary income tax rates. But if you take money out before 59 and a half, you will get a 10% penalty with few exceptions, in addition to taxes. Also, you can't keep money there forever. You must start withdrawing it when you reach 70 and a half or pay a 50% penalty, okay? Now, the current for this one is already 72 years old, so the government has extended this age, okay? So most tax later accounts are designed this way. However, some tax later accounts are tax deferred but not tax deductible. For example, the money put into a non-qualified annuity or a non-deductible IRA is after-tax money, which is non-deductible. The tax only applies to the gain at withdrawal, which has been tax deferred, okay? Canadian RRSP rules are different from those in the United States. However, okay, the basic functioning is similar in that pre-tax money goes into an RRSP. Tax is deferred, but ultimately tax must be paid once the money leaves the RRSP. To learn more about the specific details of RRSPs, visit this link, okay? What is tax advantage? Tax advantage means you generally won't pay tax when you withdraw money from your account. Oh, isn't that good, right? Tax advantage investment money is after tax money because you have already paid taxes on it. Okay, Roth IRAs, 529 college savings plans, TFSAs, and life insurance are popular investment vehicles that get tax-exempt distributions. In Canada, tax-free savings enjoy tax exemptions, okay? So contributions are made with post-tax dollars, but no taxes paid when withdrawals are made. RESPs and RDSPs have some features that are taxed later and tax exempt. For more specific features of these plans, please go to this link. So now you have to decide. So do I need to decide on being taxed now or being taxed later? Okay. So based on your engines that you have now, your financial products, see if you're gonna have to pay tax now, you're gonna have to pay tax later, or is it good to pay tax now, or is it good to pay tax later? Okay, so should you avoid paying tax now and defer it until later when you get old, or should you pay now and not worry about tax in the future? In other words, should you pay tax on the seed or pay tax on the harvest? Okay, let's take an example of Miss A and Miss B, who both have $10,000 to invest at an 8% rate of return over 36 years. According to the rule of 72, their money will be doubled every 9 years. Okay, so Miss A chooses to pay tax later while Miss B chooses a tax advantage vehicle and to pay tax now. Assume the current rate of both women is equal to 25%. Okay, so Miss A will start with $10,000 pre-tax money, and Miss B will start with $7,500 after tax money. So Miss A was not taxed yet, but Miss B was already taxed. Okay, both are 29 years old. So here, as you can see, they start at 29. Okay, Miss A was not taxed, so she's putting her money total of $10,000, while Miss B was already taxed. Okay, so she's putting $7,500 already on the investment. Okay, so at 65, as you can see, A now has to pay taxes. Okay, retirement time. Okay, at this time, however, the tax rate may have changed, so we don't know. Miss A may have the different tax rate, and Miss B has a different tax rate. Okay, so if the tax rate is the same at 25%, okay, so $160,000 minus 40,000, which is 25% of 160,000, is 120,000. So Miss A and Miss B are equal. Okay. So if the tax rate lowers to 15%, okay, which means Miss A is gonna have to pay, less 15%. So 160,000 minus 24,000, okay, which is 15% of 160,000. So Miss A now has 136,000. So Miss A is still ahead of Miss B, okay? So if the tax rate hikes up to 35%, which we don't know, this can happen, okay? So Miss A has 160,000 minus 56,000 because that's 35% of 160,000. So which means Miss A only has 104,000 at the end. So she will not be able to get $160,000. Okay. So then Miss A loses to Miss B if the tax bracket is 35%. So that's how you see, if you're going to get taxed now or if you want to get the tax advantage, which is you already have paid your taxes up front and you won't have to pay taxes in the future. Okay. So Miss B, okay, pays taxes. Let me see. Miss B pays taxes on the seed, which is 25%. Okay. Miss A pays later on the harvest, the taxes of which could be lower or higher than 25%. So that's the risk. Okay. So you have to decide, is the tax rate going to be higher in the future, or is it going to stay, or is it going to go down? I doubt it going down, okay? I think it's going to get higher, okay? So both Miss A and Miss B take a calculated risk based on their prediction of their future tax rate when they finally withdraw their money. So some people think like Miss A, when they're old, they will make less money, so they will pay a lower tax rate. I think this may not happen because in the future, tax rates are still going to go up, okay? However, others think like Miss B. With the trends of an aging population and higher budget deficits, the government will raise taxes. I agree with Miss B, okay? So people like Miss B also believe they may still make good income in the future. They would rather pay taxes now on the seed and not worry about taxes when they harvest the big crop later. So you decide, are you going to be like Miss A, or you're going to be like Miss B, okay? So as a final note, okay, final advice, remember, not all strategies work the same for everybody. It takes financial understanding and proper planning to find a good solution for your personal financial goals. Okay, that's why I do this book review, because not all people have access on this Saving Your Future book. And it's a very, very cheap book, but you know what? This can really save your future. Okay, so that's our final video for this quarter of the year. I'll see you again in spring break when I get my vacation again, and hopefully, go back on the videos that I have created so that you can learn more. And if you have any comments, comment on the link after this one, or comment on my page, or comment on the group page that we have. Okay, so this is again Elisa Belderol, Crusaders for Financial Literacy. I hope you're also going to be joining me in my campaign, because I need more people to spread this good news. Okay, help people change their lives and help people become financially independent. Thank you so much for listening and watching. I'll see you again next time. Bye.